In today's video, I'm going to share with you 5 simple tips that will help you become a better investor. Hey everybody, I'm James Conole, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. When it comes to investing, there's a lot of stuff that you need to know to really do it right. But at the same time, there's some simple fundamental truths that most people miss, and if you understand these simple truths and these simple tips, it will change the way you invest and help you to build serious long-term wealth. There's 5 key tips, and I'm going to share those with you today. The first tip is understanding the power of compound interest. Here's an example to show how that works. If I said I'm going to give you 2 choices, I will either give you $1 million today, or I'll give you 1 penny today. But that penny is going to double in value every single day for a month, and I give you 10 seconds to choose, which are you going to select? Now you're probably going to sit there and probably try to work out the math pretty quickly about that penny. Okay, 1 cent, 2 cents, 4 cents, 8, 16, 32. It's not really growing that fast. You only have 10 seconds to make a decision. You're probably going to choose that $1 million. That's what most people will do. Well, here's the thing. At the end of that month, at the end of that 31 days, the penny that doubles every single day, it's grown to over $10.7 million. When you hear that, it's almost mind-blowing because you think, how could that possibly happen? I already went through 5, 6, 7, 8 days and I was up to like 64 cents. How could that grow to $10.7 million? Well, that's the power of compound interest. In fact, if you look at that whole month of the journey from 1 penny to $10.7 million, you're at about $164 halfway through. So even if you were able to make it to day 15 of that month, you're still thinking, why did I choose this penny when I could have chosen that $1 million? That's how compound interest or compound growth works. So much of the growth doesn't happen on the front end, it happens on the back end. So as an investor, as you're investing money and putting money to work for you, understand as you're getting started, even in the middle of the journey, you're probably not gonna feel like there's that much money for you. Where the real growth happens, where the real magic happens is on the back end. But even though it happens on the back end, it requires doing a lot of work on the front end in order to realize the benefits of that magic. Now, let's come back to reality for a second. There's not an investment in the world that actually doubles in value every single day. If there was, we could do a month's worth of investing and probably be set for life. The reality is that investment doesn't exist, so what we can do is let's choose a very simple investment that does exist and use that as our baseline. So if we want to use a more realistic example here, let's look at the long-term return on the S&P 500, which is about 10% per year as we look over multiple decades. So 10% per year is realistic, and let's now go to point number 2 to see how the power of that works. Well, tip number 2 to being a better long-term investor is understanding the rule of 72. The rule of 72 is this. It says if you want to understand how long it actually takes to double your money, because it's probably not going to happen every single day like that penny example, but if you want to understand how long it actually takes to double your money, take 72, divide it by the growth rate you can expect, and the result is how many years it will take you to double your money. So for example, if I could get the S&P 500 and I can grow by 10% per year on average over time, what that's telling me is it will take about 7.2 years for me to double my money. So 72 divided by 10 equals 7.2. As crazy as that sounds, that rule is how it works. Take 72 divided by any interest rate, and you're gonna more or less get the number of years it takes to double your money. So if we look at a rate of 5% instead, and go ahead and use your financial calculator to check the math on this, but if you get 5% instead, we'll divide 72 by 5, and what you'll see is it's gonna take 14.4 years to double your money in that case. So why is this even relevant? Well, let's assume you're an investor and you've got 29 years to grow your money. Kind of an odd year, but I'm gonna show you why I chose that specifically for this example. Now, if we go back to those 2 examples of what if you grow your portfolio by 10% per year versus what if you grow your portfolio by 5% per year? Well, on the one hand, you're gonna double your money every 7.2 years or so, and on the other, you're gonna double your money every 14.4 years or so. So where does 29 years come in? Well, let's assume that you double your money every 7.2 years. So that first period, 7.2 years, you double your money. Then you have another 7.2 years, which brings you to 14.4 total, you double again. Then another 7.2, which brings you to 21.6, and then finally another 7.2 years, which brings you to 28.8. So not quite 29 years, but what you've effectively had over the course of that time period is 4 doublings of your money if you grow at 10% per year. And here's the cool thing. When you look at that, it's not, okay, double, so 2 plus 2 plus 2 plus 2. It's 2 times 2 times 2 times 2. So you've effectively grown your money by 16 times over that 29-year period. So if you have $100,000 at the beginning of that time period and you don't add a dime to it, well, that $100,000, it's gonna grow to $1.6 million at the end of that 29-year period. Now compare that to the person growing at 5% per year. Again, it takes them 14.4 years to double their money. They only have 2 of those doublings that they can fit in a 29-year time period. So when you look at that, they can double once and then double twice. So 2 times 2, they've grown their money by 4 times. So if you take $100,000 at the beginning of that time period and you double it and then double it again, you have $400,000 at the end of that. This is really powerful to understand because when you look at 10% versus 5% growth, well, maybe it doesn't seem like that different. You might think, okay, I'll get double my money with 10% versus 5%. But when you understand the power of 72, when you understand the power of doubling and compounding, what you see is growing at 10% per year over this time period. It gives you 1.6 million versus growing at 5% over this time period, giving you 400,000. You've more than quadrupled your money by no effort of your own, but just by getting that better long-term growth rate on your dollars. So you might be thinking, great, is all I have to do put my money in the S&P 500 and I'll get 10% every single year? Not quite. And to understand that, let's go to tip number 3. Tip number 3 is to be a better investor, you must understand how bear markets work. And what I mean by that is you must understand the length of the average bear market. So when you put your money in the S&P 500, it doesn't just give you 10% per year like clockwork or like a CD where you can expect it year in and year out. You've actually never grown by 10% per year exactly in the S&P 500. The range of returns are huge in any given year. You might be up 40%, you might be down 40%, but when you average all those returns, it comes out to about 10. Well, to get that, you have to have the right expectations. I've seen too many investors so excited to get this growth, they want to grow their money, they put their money in, and then the market drops. And they say, what on earth is this? I'm losing money in the S&P 500. I thought I was supposed to be making money in the S&P 500. Well, you do, but only if you have proper expectations, which is you will have your money go down in value several times over the course of your investing career. A bear market is defined as any instance where that money goes down by 20% or more. And if you want to understand how long they last, you can see this chart here from Ben Carlson to Wealth of Common Sense. He breaks it down, looking at every single bear market since the end of World War II, not including the 2022 bear market, but every other one. And what you can see is this shows you how many days on average does the market drop, and then how long does it take for the market to recover back to break even. Well, this ranges greatly. You have some bear markets that don't take very long to hit the bottom. You have some that take a long, long time. But what you can see here on the averages is it takes just under a year for a market to fully fall, meaning from its peak to the trough. You don't know where the trough is in the midst of it. You only know with the benefit of hindsight, but it takes just under a year on average for the market to fall to its bottom, and then it takes about 1.7 years for it to break even again. So as an investor, you have to be willing to accept that. If you want those great long-term returns, so we talked about the S&P 500 returning 10% over time, you got that despite these downturns. So you didn't have to get out at the right time and in at the right time. That's darn near impossible. No one can consistently do it. What you do need to do is you do need to write it out. You have to have not just the investment strategy that will allow you to do that, but you also have to have the temperament. If you can't stomach those downturns, that's perfectly fine, but you're not going to be in a position to get those strong long-term returns either. So as an investor, tip number 3 is understand how bear markets work. Because yes, it's great to get the long-term growth, but you have to go through some valleys. And as you're going through those valleys, you have to be mentally committed to sticking with it, because everything inside of you is going to want to pull your money out, wait till things get better, but doing that is a sure recipe for disaster. So great investors, they have both the discipline and the patience to stay committed through market downturns in order to get those superior long-term returns that great investors deserve to get. Now, tip number 4 to becoming a better investor is to also understand the range of potential returns. It's not enough just to know the market will go down, and it might take a few years for it to recover again. You need to understand how far the market will go down. Think of it like this. If you're expecting to go out for a nice leisurely hike and you think it's gonna be pleasant, maybe you're even wearing flip-flops and a t-shirt because it's just gonna be a grand old time, and all of a sudden you have a horrible thunderstorm, and all of a sudden there's obstacles, and all of a sudden there's steep inclines along the way, well, you as a hiker are gonna be totally unprepared for that, and you're probably gonna go home. That's kind of like investing. If you think you're going to have a pleasant experience and it's just gonna be a nice leisurely stroll from here all the way until retirement, you're gonna have a tough time at it because those obstacles will be there, those rainstorms will be there, those challenges will be there. So if you go back to the hiking example and you're prepared for that, you know there's gonna be steep inclines, you know there's gonna be some switchbacks, you know there's gonna be really horrible weather, well, you prepare for it ahead of time. And by preparing for it ahead of time, you're mentally and emotionally prepared for those moments so that you can continue going even when the bad things happen. As an investor, it's the same exact thing. Let's actually take a look at what this looks like. If you take a look at this chart here, what this is showing is since 1976 through August of 2022, this is showing the ranges of outcomes you might expect on the S&P 500. So these blue bars here, what this is showing you the range of outcomes you can expect on that very same investment that I told you averages 10% per year over long periods of time. I also mentioned it does not ever return exactly 10%, at least it hasn't historically yet. So what we look at is we say, okay, what's the best ever year that it's had? Well, its best ever year, it was up 61% in a single year. That's a wonderful 12-month experience in the S&P 500, but the worst ever experience, it was down over 43% in a single year. So as you look at this range of outcomes, that's really difficult. This is the equivalent to going on a hike and having no idea what you're going to be hit with, so you need to prepare for the worst, and in doing so, it will allow you to be prepared for the best as well. So yes, can you get great long-term returns with the S&P 500? Absolutely you can, but don't expect it to be consistent every year. Expect huge ranges of outcome, but also know those ranges of outcome, while they start like this, they do start to narrow over time. Here's what I mean by this. Let's now fast forward to 5 years. Well, what you've seen is the range of outcomes. The high isn't so high, goes down to that, but the low isn't so low, goes down to that. So the best 5-year return, the annualized return was 30% per year, and the worst 5-year return it's had over this time period was negative 6.6%. So as the range of outcomes started here, they start to narrow. Well, now let's go to 20 years. Over 20 years, what you see is the range of outcome starts to get really narrow. Those down or those worst possible years, they're still gonna be well below the long-term average, but they're not gonna be nearly as bad. But also the higher end of that range, it's gonna be better than the long-term average, but it's not gonna be quite as high as any potential 1-year or 3-year or 5-year returns. To quantify it, the best ever 20-year time period the S&P's had during this time period was up about 18.2%. And then the worst 20-year time period it's had during this time period, it was up about 4.8%. So you have to understand that in the short term, your range of outcomes could be here. But as you stay committed, as you stay on the path, as you keep doing the disciplined thing, that range of outcomes really starts to narrow. So yeah, you probably won't get exactly 10% over the next 20 years, but it's gonna be somewhere close. The range of outcomes isn't gonna be as sporadic the longer you remain invested as an investor. And then tip number 5 to be a better investor is know your critical mass number. What on earth is a critical mass number? Well, I kind of made up the name, but what it is it's the point in which your portfolio is doing more legwork than you are with your own investment contributions. So it's essentially the dollar amount you need in your portfolio so that the average growth on that portfolio is outpacing what you can put into your portfolio with new contributions. And the way you find that is you divide your contributions, so how much are you putting into your portfolio, divide that by the growth rate that you might expect from your investments over time. Let's look at an example. Let's assume that this year you're maxing out your 401k. So that's $27,000 that you're putting into retirement, and that's the only contribution you're doing. There's no Roth, there's no brokerage account, HSA, nothing else, just the $27,000. And let's assume your employer puts in a 3% match or a $3,000 match. So let's just go ahead and assume your total contributions are $30,000. Well, if you're getting an 8% growth rate or expect an 8% growth rate, if you divide 30,000 by 8%, you get $375,000. What does $375,000 tell us? It tells us that if you have a portfolio of that amount and you get 8% per year on that, that 8%, at least in the first year, comes out to exactly $30,000. So the fun thing here is what you start to see is once you hit that crossover point, your portfolio, at least on average, is doing more of the legwork for you and less is required from you. That's not to say you shouldn't contribute anymore. It's not to say you should shut down your contributions, but what it is saying is your portfolio and the growth on that, it's starting to outpace you in terms of how many new dollars you can add to your portfolio. Really, this just goes back to tip number 1, which is understand the magic of compound interest. Here's another way of looking at that. Let's assume you're just getting started on your investment journey, and you're gonna put $10,000 away for retirement this year or into some investment. Well, if you put $10,000 away and you get the long-term return on the S&P 500, assume you get exactly 10% this year, well, your 10,000 grows to 11,000. So that's exciting, but it's really not that material of a difference. You put in 10, you got a little bit of growth, but really most of that portfolio is you. It's your own contributions, and that will continue for some time. Well, let's assume you keep doing that for years and years and years and years, and now you have $1 million in your portfolio, but you're still putting in that same 10. Well, if you get that same growth rate of 10%, 10% on $1 million is now $100,000 of growth, even though you're only putting in 10. So you can start to see the power of that is when you first start investing, all the legwork, or majority of the legwork, it's coming from you. But as your portfolio keeps growing, as you stay committed, as you hit that crossover point, that critical mass number, your portfolio at some point starts doing more of the work for you and less is actually coming from your new contributions. This is why I'll often tell people that longevity of work is sometimes more important than intensity of work. Meaning on the latter end of your working years, sometimes it's less important to earn a whole bunch and save a whole bunch, and it's more important to work longer, even if you're not saving as much, because it's your portfolio that's working in overdrive at that point. And if you're spinning your wheels and working a high-stress job, and yes, you're earning a great income, well, that's great. But if your portfolio can do more of the work for you, then the most important thing you can do is let your portfolio continue to work by earning some income, not necessarily having to save it all, but earning enough to let your portfolio do its thing, so by the time that you do need it and you do retire, it's worth a greater amount. So owning great investments is important, but it's only one part of true long-term investment success. The greater part is actually being a better investor. And if you understand these 5 tips, then you're well on your way to becoming a better investor. Now, if you want to learn more about how can you be a better investor, how can you better create an investment portfolio for your retirement, well, be sure to check out this playlist above. Once again, I'm James Conole, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.